Okay, so this is edition 2, how you set up the accounting books for a sole proprietor with a small business. Reloaded. This is how you set up the books with an actual accounting software, QuickBooks Pro software of choice, as I had promised. Okay, so here we go. Okay, as you recall, the name of the company is My 5 Cents, and the first thing you do is set up a chart of accounts. And the owner of this demo company is Bob Kunamuna. Okay, so the program is newly installed. It'll look like this after you install the QuickBooks. And it's a earlier version, 2009, but they're all about the same. You know, different little bit updated features here and there, but the basics are the same. And the views or whatever may change from, you know, different upgraded version, from a different version to another version. I think I'm using 2011 at my full-time job. This is something that I do as an on-the-side business that hopefully will become my main business, full-time business in the near future. Alright, so you want to create a new company file. Okay. Skip the interview if you already know how to do all that stuff, or you go through the interview phase. And you enter the company name. And it's My 5 Cents. Okay, tax ID if you have one, enter that information in. You enter the street address and the city and everything. You fill all this information in according to, you know, your business, your personal business information that you have. Alright, Georgia. And it's actually Hampton, Georgia, but it's in Metro Atlanta City. Phone number. Fax, email address. Alright, so you fill all that information out, and says virtual at gmail.com. Okay. Sole proprietorship, or it's a partnership, or it's an LLC. Fill out and select the type of business that you have. Next. My fiscal year starts in January, or you could choose July. A lot of companies have their fiscal year, it's different from the calendar year. So instead of going from January to December, they have maybe from July to June, which is the case for the full-time company job. I mean, the job that I work for. Okay, or you can go from October. A lot of them choose October as well, October to September. So you can choose whichever. Let's to simplify. Let's just go with January. Okay. What's your industry? And Bob is in, I guess, information technology, huh? Buy and sell, repair and maintenance. Okay, so you choose the business field that you're in. Okay, an industry that you're in, and you move on. This is your QuickBooks information is stored in a file called the company file. Click next to choose a file name and location to save your company file. Okay, it's going to be stored in company files, and the name of it is my 5 cents, and it's saved as type QuickBooks files, and you save it in company files, or you could choose wherever you want to save it. Okay, company files is fine. Okay, save, creating a new company. Okay, so I mean, this part of it is the most time-consuming part of it. You know, entering in your information, getting the chart of accounts set up, and so on and so forth. Okay, just a few final screens remain to set up your Intuit account. Click next, remind me later. Now, advertisement you could refer back to at any time. And this is the home screen. It shows the whole design. Okay, it's like a flow chart of how information flows. Enter bills, pay bills here, create invoices here, estimates received, payments here, goes to here, record deposits here, goes here. It's just a whole flow chart, basically how the system works, and you know how some of the transactions flow from one to the next. You could go through a tutorial if you want. Just in the interest of time. Okay. Go in here to company, and we're looking for chart of accounts. Okay, and here we have your chart of accounts, and you could edit this and customize this to the chart of accounts that we already know that we want it to be. Okay, so yes, for instance, furniture and equipment. We don't have a furniture and equipment. We have a vehicle and equipment, so we'll edit that. Oh, excuse me. Someone is calling about business. Okay. Let's right click on that, go down to edit account, and we'll change the name there to vehicle and equipment. Okay. And it's vehicle and equipment with useful life exceeding 1 year. Okay. Save and close. Right there, you have this one could just be revenues. Okay. And example, we're going to edit account. This one could just be revenues. Sales refurbished. Okay, so change all those, and then we'll be back with the second part of what this looks like after we get them all changed. I'll go ahead and I'll restart. When I start again, I'll start at that point where we have the chart of accounts the way it should appear after editing, adding, deleting, this whole QuickBooks chart of accounts. Okay, so here is a chart of accounts after we edited the template that we were given. Okay, so the chart of account now looks like the chart of accounts that we had in the Excel spreadsheet. Okay, two things. I went ahead and I added building and accumulated depreciation building, and I also added land as long-term assets or fixed assets, and also unearned revenue. QuickBooks doesn't allow for the creation of an unearned revenue account, or it would not work in QuickBooks actually, and that's one of the known things about QuickBooks. Okay, as great of a software that QuickBooks is, this is one of the shortfalls of QuickBooks. It does not use an unearned revenue account. What it does is it does a negative or a credit to AR. Unearned revenue, that's usually money that you received in advance, okay, for a sale. So you haven't sold anything to the customers yet, but yet the customer is paying you. Or you haven't performed any service for the customers yet, but yet the customer have paid you. So that's not your money until you perform that service, or until you actually exchange or give that customer possession of the item that the customer is going to purchase. Then it becomes earned revenue. So until then it is a liability. It's unearned revenue. That's the customer's money. Okay. So instead of that being an accounts receivable, it's an opposite to accounts receivable. Okay, and so QuickBooks uses, they actually credit the accounts receivable account. Look at unearned revenue as a negative AR, negative accounts receivable. Okay, so that's it for unearned revenue. Let's get back. Okay, and as you recall, the way to edit the accounts, you click on the account, you right click on it, you go to edit account, and you change the name or whatever have you. Okay, the very first thing you want to do after creating your chart of accounts in QuickBooks, you want to enter in those opening balances. Okay, enter in those opening balances that it's going to be reflected, or that has to do with your capital. Okay, so enter in those opening balances that is tied to your capital account. Okay, what is your capital? Your capital is stuff that you actually owned coming into the business. Bob owned two things. That's all he owned coming into the business. Okay, he owned a $15,000 vehicle, and he owned $1,500 worth of the inventory. So those are the two things that are his equity, his capital, and you enter those two things in first. Okay, so you would go to vehicle here, right click on it, edit account, and here it would say enter opening balance and not change opening balance. Okay, and you enter an amount in. For example, let me show you quick. Let's say building. Let's say that the Bob had building coming into the business. Okay, right click on it, go to edit account. Here we go. Enter opening balance. You enter it, and you as of, and usually it's the day of the business, or the day you started up in QuickBooks, or the day right before. Okay, in my case I chose the day right before. Okay, and we have another business call. And all right, the same likewise, that's what we did for inventory. Right click on inventory. I'm sorry about that. It's me. Phone tend to always ring. I should have it on silent while I'm doing these demonstrations. I apologize once again. We go to edit account, and here it would say enter opening balance again. You click on enter opening balance, and you would put in the $1,500 or whatever amount, you know, as it pertains to your business. Okay, so those are the two things you do, and those go automatically to the equity account, Bob Kunimuna Capital, which is rightfully so. That's where they should go, and that's his equity, that's his capital. Okay. Also accounts receivable and accounts payable, those two accounts, those are actually automatically generated as you record transactions and as the business moves forward. Okay, likewise a cash account, you know, as you record a transaction or you receive payment from a customer, it goes to an automatically generated cash account. So, excuse me, so cash, accounts receivable, and accounts payable generally doesn't show up in any of the generic or any of the templates the chart of account templates that QuickBooks gives you. Okay, those get automatically thrown in there as time goes on. So after entering in the inventory and after entering in the vehicle, which was the two amounts which were automatically posted to capital, the next thing you want to do is record the transaction, the journal entry for Bob's loan. Okay, Bob's loan was for $10,000. Okay, and I actually went ahead and did a journal entry for that one, and this is what a journal entry looks. Let's go here, journal. Okay, so I debited cash and credited long-term payables, $10,000. Acquired 5-year loan from bank. That's it. Okay, and that's what gave me this $10,000 here in long-term payable. Okay, and I also had $10,000 in cash or bank account at that time. But then I went ahead and recorded another journal entry, which was a journal entry to pay all his operating expenses and miscellaneous expenses. You know, so let's take a look at that journal entry. Okay. Yeah, he paid for office supplies, he paid for rent expense, repairs, and all the other operating and miscellaneous expenses for a total of $1,370. Debit all the expenses, credit $1,370 to cash. Okay, paid rent and other operating and miscellaneous expenses. Alright, simple. Alright, so that shows a net amount for the cash account, $8,630, and all those expenses, those are paid off, so there's no balance showing for them. Okay, so that's the second thing you do. The third thing that you end up doing is, okay, Bob bought $1,000 worth of the inventory on credit, as we had already discussed. Okay, and he had to had purchased that inventory from a vendor. Okay, and so we created a vendor. Okay. We created a vendor, which was Johnny's Computer Salvage Yard, and we recorded a transaction or the purchase of that $1,000 worth of salvage computer that Bob put into inventory and is available now for resale. Okay, so amount due is $1,000. Went to the inventory account. You could choose the accounts that you want it to go to. It obviously was inventory. Okay, and so we recorded that transaction. Still haven't paid it as yet. It's still sitting there. Okay, and that's how comes we had the additional $1,000 go to inventory, in addition to the $1,500 that was there already from Bob's pocket, you know, when he started up the company, and also that $1,000. Remember, I just said he still hasn't paid for it as yet, so it's still sitting there in accounts payable, and that's how comes we got this balance here for accounts payable. All right, pretty straightforward. How did I actually create the information for the vendor? You go to vendors, go to vendor center, and you could click new vendor here, and the vendor's name, and here you fill all the information, and voila, you have a newly created vendor. And after the vendor is created, then you go to vendor, enter bill. Here we go. Select the vendor. In this case, we have one vendor so far. Enter the amount. Enter the account it's going to go to. It automatically assumes that I was going to inventory, but it could go to anywhere. I could buy building from that person, or whatever, supplies. Let's say I had supplies in here. Then I would click on supplies, or or whatever have you, or if it's just an expense, when I click on that expense, enter the amount on a short note, and that's it, and that gives rise to the accounts payable. Okay, and that expense or whatever you purchase, supplies or inventory. Alright, so pretty straightforward. And then also Bob made a sale, as we said, for $1,250. This one was done, pretty much the same way as the vendor transaction, but now we have it's a customer transaction. So let's see what we did here. You go to customers. Okay. Customer center. And let's say we created a new customer. Okay, and the new customer was Mary. I went ahead and entered all the information in. Mary Wonders. Enter all the information in. Okay. And we had Mary there. And from there, I right click to Mary's name, create invoice. Okay, the date of the invoice, the terms, and what I sold to Mary, refurbished computers. Okay, how many, description for the rate, the amount, and just went ahead and created that invoice. Okay. And after that, after creating that invoice, now I have Mary sitting there showing that she owes me $1,250, or owes Bob $1,250. Okay. And that's how I arrived at accounts receivable for $1,250, and it shows the revenue. doesn't show the revenue in this case. Assuming it's on the date of her after the end of the month, and since these are for a period of time, your income and expenses are all income statement accounts are for just a period of time. These accounts get closed out, and so they don't really show the updated balances. But all your balance sheet accounts, if you notice, from balance sheet accounts, those generally have a balance. Okay, it shows a balance because those are ongoing, and at any given point you could click and get an updated balance check on what the balance in those balance sheet accounts are. That's why the balance sheet is for a specific time. Okay, write it over a period of time. Alright, so that's all you do, and that's all we have for as far as setting up the company. So we entered in the opening balances, and then we made a couple journal entries, and then we created a vendor, created a customer, and we created an invoice for the customer, and we created a bill for the vendor, and we entered in those amounts, and we're here now at this point. Okay, and that's all we had as far as getting the company set up. Okay, I like the customer center view. I usually keep mine here so I could always see who owes me what and what monies I have that are due. Okay, so now let's look at the reports and see if they match up. Okay, first one. Okay, if you notice, this may be why those account balances are showing what they're showing. Okay, if you notice, it's here on the first day of the year, but the period that we want it for is for December 1st through December, through December 31st. Okay. Alright, so here we go. Net income or net loss for $120 looks exactly the same way as the spreadsheet. Okay, $120. Okay, next up, let's look at the balance sheet. We don't have a statement of owner's equity here. There's a net worth graph, which is assets minus liabilities. Let's look at the balance sheet. All right, so total assets $27,380. $27,380, and look, retained earnings for $120, which is right for the sum. Look at this equity section. This is exactly how it should be. Okay, you get $16,500 in equity. In capital, and remember, retained earnings is an accumulation of net income or net loss over the years. This very first net loss gets recorded. Total equity at Bob Kunamuna updated capital as of December 31st or January 1st, 2014, $16,380. And remember, this is the habit that I said I try to get into, and I usually follow, is to record, the equity section as two separate line items, rather than just going with the statement of owner's equity, one summarized amount, and just one line item amount in that equity section. So looking at the Excel balance sheet, that is exactly what we see. It's the exact same thing. $27,380 in assets, $27,380 in liabilities and capital. Retained earnings for $120. a capital for ending capital for $16,380. It's the exact same thing. That's what we're looking at in QuickBooks. Okay, so it's good to see how these numbers get generated in a computer program and accounting software. Okay, understanding the calculations behind the back screen. Okay, and that's what the Excel version shows you. Okay, we're manually doing this, and we're manually calculating all these account balances and transactions, and every single step of the way. Okay, and QuickBooks automatically generates and links a lot of the transactions into financial statements, and it just gets populated automatically with all the work being done in the back screen, or computer generated in the back screen. So it's good to understand how those figures are actually generated and what's the concept of it. Okay, let's look at the statement of cash flows. Okay, again, it's for over a period of time. So we're wanting December 1st, 2013 to December 31st. Okay, and here we have it, the exact same statement of cash flows. Okay, let's see, statement of cash flows. Yep, the exact same statement of cash flows. Okay, and net income, we had accounts receivable, which is a credit sale. It wasn't really cash coming in, so we subtract that from net income or net loss. We have inventory, which is aside from the opening balance, or assuming that you would pay for the inventory, so you subtract that from net income. The flip side, or offsetting short-term liability for that inventory purchase is accounts payable. An increase in accounts payable means that you actually then let go of cash. You actually then pay for that inventory, so that gets added back to net income. Tells the true story that there was zero cash exchange in that operating activity transaction. Okay, so nets out, and then you have the long-term payables, the 5-year loan, which is a financing activity, and so it shows up under financing activities, and here we have it, cash at the end of the period. Exact same thing we have in the Excel spreadsheet. Okay, but again, the Excel spreadsheet is just showing every step of the way and all the calculations that goes on in the back screens of the accounting software. Okay, and that's very, very important. So the accounting software and the creators of the accounting software, their limitations go as far as their in-depth knowledge, of the concepts. You know what I mean, or how these financial statements are actually created, and how transactions get recorded. And so, for instance, with the unearned revenue, I believe that in the near future, when they really grasp the concept of that, and then that gets implemented into the software, and then we will see that in QuickBooks, which is very necessary, I believe. Like I said, that's money that you actually owe. That's not for you until you actually earn that revenue. So that's a liability, and it should show up as unearned revenue. QuickBooks shows it as a negative AR, all right, credit to AR, and we all know that the rightful, or the normal balance for accounts receivable is a debit. So usually it's never credited unless you're writing off bad debts or something like that. So, or the customer actually pays for that sale that they made on credit, or they got from you on credit. Okay. But still, overall, a great software, a great accounting software for a small business. All right, so we have come to the end of demo number 2, how to set up the books for a sole proprietor with a small business using an actual accounting software. In this case, using QuickBooks Pro. Okay. If you have any questions or didn't catch anything, just shoot me an email or give me a call, or get in touch with me, or link me on, or subscribe to me. Just get in touch with me. I'll be more than glad to go over whatever you missed. Or if you have a question that's unique to your business that you're doing, and your business is at this stage, you're trying to set up the books for your company, just give me a call, or like I said, shoot me an email. The next thing we will be doing is the tax returns for the business. It's a flow-through return, so it's actually going to be in Bob's tax return. But that's what we're gonna demonstrate next. We're gonna do a demo showing the tax return for a sole proprietorship. Okay, and using these financial statements, how to use the income statement to do the return. Okay, to make it easier. All right. Okay. Until next time, I wish you all the best of luck. Okay. Hope that your business dreams come true. And I hope to see you at the next level. Until then, SVE forward.